Understanding financial charts, currency markets versus other financial instruments. Welcome to today's episode, where we're exploring the unique characteristics of currency charts compared to other financial markets. If you've ever wondered why currencies behave differently than stocks or crypto, this is for you. Let's start with stocks. Company shares tell a story of business evolution. Early in a company's life cycle, innovation drives growth, better manufacturing, new products, expanded markets, all pushing stock values upward. But eventually, every business hits a ceiling. They reach what I call a saturation point where further improvements become increasingly difficult. That's when competitors enter, often copying successful products at lower costs. At this stage, stock charts begin to oscillate more dramatically. They become reactive to policy changes, management decisions, and market conditions. Companies must either boost sales or cut costs to stay competitive, creating the characteristic volatility we see in stock markets. Metals and commodities follow different rules. These markets face natural constraints, limited mining capacity, processing capabilities, and predictable demand patterns. These physical limitations create unique chart behaviors driven by resource scarcity and production costs. Cryptocurrencies represent perhaps the most volatile charts. Unlike traditional assets, crypto lacks the fundamental barriers that restrict new market entries. Anyone can launch a new coin, and with limited regulation, these markets show extreme peaks and valleys as sentiment rapidly shifts. Market indices simply aggregate top companies' performances into a digestible format, smoothing individual volatility while highlighting broader economic trends. Now, let's focus on what makes currency charts different. Currencies represent something fundamentally distinct: the relative value between two nations' economies. This relationship creates unique oscillation patterns that rarely experience the extreme movements seen elsewhere. Currency pairs don't typically go through the roof or crash through the floor, entirely because they reflect a balance between economic systems. If the US economy strengthens while Europe's remains stable, the EUR-USD pair will show this shift. If Europe's economy grows while America's slows, the chart moves accordingly. This gives currency charts their distinctive character. They develop predictable patterns, double tops, head and shoulders formations, ascending triangles, especially visible on lower timeframes. Traders can place orders at key levels and wait for prices to arrive, a strategy particularly effective in forex markets. One of the most appealing aspects of currency trading is its relative simplicity on daily timeframes. Watching how daily candles form often signals potential trend changes without requiring extensive analysis beyond recent price action. The oscillating nature of currency pairs creates opportunities in both directions. Unlike stocks, where long-term investors primarily seek upward trends, currency traders can profit equally from appreciating and depreciating markets. Additionally, forex markets operate virtually 24 hours a day, 5 days a week, providing accessibility that other markets lack. This continuous environment means patterns develop and resolve more fluidly, without the gaps often seen in stock charts. For traders seeking predictable setups, currency charts offer rich territory. Major currency pairs show relative stability compared to speculative assets, making technical analysis often more reliable. Price levels and patterns tend to respect historical precedents more consistently than in markets driven by breaking news and rapid sentiment shifts. Understanding these differences empowers you to choose markets that match your analysis style, risk tolerance, and trading goals. Thanks for listening to today's episode. Until next time, happy trading. ltrfxc/substack.com